you are. So we'll kind of go that route to start with. Again, hit the chat room if you've got any questions. We're going to do a little breakout room session once we get through chapter 1 tonight. Just a short little mini case on a cake company that's looking to expand, and kind of talk a little bit about some of the options that they have in front of them with regards to legal entity structures, whether it's a sole proprietorship, LLC, LLP, C corporation, S corporation. Should only take about 5 minutes for breakouts, and we'll all come back and kind of share our thoughts before we move into chapter 2, which is where we really start to dive into, kind of the meat of the semester. As I mentioned in our first class 2 weeks ago, the first half of the semester is kind of like drinking from a fire hose. Everything builds upon itself, okay? Tonight we're going to talk about financial statements, the 3 different financial statements, how they work together, how numbers move in between each financial statement. If you're already in finance, if you're already in accounting, what we're going to talk about tonight is going to be a little bit maybe watered down for you compared to what you're used to. But nonetheless, it's designed to kind of give you exposure to how money moves from the income statement to the balance sheet to the cash flow statement, and then how the accountants go about producing those financial statement documents that get submitted to the SEC or other regulatory agencies, versus how management actually goes about using those documents. So hit the chat room. If there's anybody in financial planning and analysis, please let me know in the chat room so I can kind of respond to that as we go through tonight. Because what happens is, the accountants are really good at what they do in terms of making sure that I's are dotted and T's are crossed on the financial statement, so that when things do get reported, if you are a publicly traded company, but then the actual management reports that the company uses to drive the business will look very, very different than what the accounting statements look like. Everything ties back, but nonetheless, the way that the management team will look at the business is sometimes drastically different than the way the accounting department produces the official financial statements. Okay. Thank you, everybody, for your discussion on emotional intelligence and your emotional quotient. I enjoyed reading all of your posts and your papers. It sounds like each of you learned a little bit of something about yourself, as well as some things that you need to work on. As I read through many of your comments, I tried to make a reply post to everybody's. It sounds like most everybody, in the class needed to have a little more empathy, and also needed to find a way to get a little more motivated. And I can totally appreciate all of those things, because I tend to be the same way in most of the things that I do. So, all right, with that said, any questions so far before we get started tonight on chapter 1? No? Everybody got some food? All right, let's go ahead and get started. So I'm going to share my screen. First thing we're going to talk about tonight is just the general kind of introduction to corporate finance. We're going to talk about different corporate structures, how, the different types of entities that exist, why they exist, which ones are beneficial, which ones are, more beneficial during specific times, depending upon the type of structure that you're looking at forming or the type of business that you've got. Okay, so with that said, so tonight in chapter 1, throughout the course of this semester, we're going to come back to this first bullet time and time again, okay? Defining what 3 key basic roles the financial manager is responsible for, okay? And we'll go through what those 3 things are here in the next couple of slides. But throughout the course of this semester, these 3 things, these 3 crucial management concepts that the financial manager is responsible for, these are the things that you need to be aware of, whether you're in finance, whether you're in accounting, whether you're in marketing, whether you're in sales, it doesn't matter, because anyone who works within the firm is responsible for one thing and one thing only, and that is to increase shareholder wealth. That's it, plain and simple, okay? And whether that is through the sale of more product, whether that is through reducing your operating costs within the division that you work in or on the team that you work in, okay, or finding a more efficient way of getting the job done, your entire job, your entire goal is to increase shareholder wealth, period. That's it. Okay, so we're going to talk about those three goals, those three specific things that you, all of you, as financial managers within your own department are responsible for. We'll talk about what the goal of financial management is, period. And I just kind of gave it away. It's to increase shareholder wealth. That's it. All right. We'll talk a little bit about some of the complications that come along with that, some conflicts of interest that may arise. And I'm going to pick your brain a little bit in terms of what your businesses, what your firms do in terms of bonus compensation. What are the performance metrics that are tied to your bonus? All right. And does that performance structure tie into the overall goal of increasing shareholder wealth? All right. And then the third bullet there, we are going to talk tonight about the different financial implications of the various forms of how we go about organizing a business, from sole proprietorship to an LLC to an LLP, general partners, limited partners, C corporations, S corporations. We'll get into that for the first part of the lecture tonight. So we're going to get into like what is corporate finance, or as my 14-year-old son says, what even is that, Dado? So we'll talk about what corporate finance is and what the financial manager's responsibilities are. The big thing we're going to get into later in chapter 1 is what those conflicts of interest look like. Okay, and that's where I'm going to get your input in terms of what your performance compensation structure looks like. Okay. So corporate finance, or finance, as I've come to call it. What are the goals? What is the responsibility of the financial manager? Okay, well, plain and simple, it's three things, and three things only, and that's it. All right. Now, once we get through all these three things, you'll see that it involves a lot of other processes: capital budgeting, the weighted average cost of capital, discounted cash flow analysis, but it all boils down to three things. First and foremost, what long-term investments are we going to make? Okay, we want to keep our business going. We know that we've got competition. We live and work in a capitalistic market. So we know that we have a product today that is not going to be as good as the product tomorrow. So what long-term investments should we as a firm take on? Right? Plain and simple. What options do we have, people? You know, if I'm the CFO, if you're the CFO, you're asking your company, bring me ideas, bring me projects that you feel are going to add value to the firm. So first and foremost, what long-term investments should we take on? After we've decided how we're going to go about allocating our capital, all right, through the capital budgeting process, right, the second question we have to ask ourselves is, how are we going to pay for it? Right? Where are we going to go about getting the long-term financing necessary to pay for the project that we're looking at implementing? Right? And this gets into kind of the heritage doll case. Right? So after tonight, you should be starting to read the heritage doll case, and you should be starting to read the Apple financial policy case. All right? Because once we get through the topics for tonight, you'll start to recognize some terms within each of those cases. Familiarize yourself with the verbiage, okay? So where are we going to get the financing? Can we finance it ourselves? Do we have enough equity to finance the project ourselves? Or do we need to go tap the debt markets, okay? How do we balance debt and equity, leverage, to go about paying for these projects that we want to do? All right, so that's the second question that the financial manager must ask. The third question is more around, all right, once we've decided what we're going to do, and once we've decided how we're going to pay for it, the third question is, how do we manage that project, those new things that just got added to the business? How do we manage that on a day-to-day basis? How much working capital does this particular project require in order to continue running on a day-to-day basis, all right? Because once we decide that we're going to do it, and once we decide that we're going to finance it through debt or equity, we're going to have to keep it running. Okay, so how do we go about doing it? What's the most optimal working capital solution for the projects that we've chosen to do? Okay, so the financial manager. The financial manager is responsible for basically answering all of those three questions, all right? Naturally, you've got the CFO at the top of the organization, and sometimes you might have two CFOs depending upon how large your organization is, whether it's domestic, whether it's divisional, whether it's global. You could have a number of, quote, CFOs throughout the company, all right? But nonetheless, the CFO, the chief financial officer at the top, is ultimately the one who has to sign off on capital allocation. How are we going to spend our money, and are we spending our money in the most efficient way possible? Okay. Aside from a CFO, you've got folks like the treasurer, all right, the cash management person. How do we go about calculating the weighted average cost of capital, debt versus equity? All right, that's the Treasury Department's responsibility. All right, capital expenditure. How much money are we going to allocate on any given year to capital expenditures? We've got the controllers, all right, the folks within the accounting department that oversee our taxes, our cost accounting, the data processing. How do we go about closing out the month? How do we go about closing out the quarter? How do we produce the financial reports that are needed that we can translate into management reports that ultimately then get converted into presentations to Wall Street analysts who eventually determine our stock price, which then subsequently determines shareholder value, okay? So there's a process through which all of this data moves, right? So when we talk about these three financial decisions, these three questions that the financial manager must ask: what projects are we going to take on? Okay, that relates to capital budgeting, right? What do these long-term investments projects look like, right? Where are they? Are they domestic? Are they global? Are they isolated to one state, multiple states? Okay, what do they look like, and what should we take on from a capital budgeting standpoint? Okay, capital structure relates to the second question. How do we go about financing these projects? Once we've decided what we're going to do we pay for these projects out of our own assets? Do we pay for these projects using debt, meaning we go to the banks and ask for money? Or do we pay for these projects out of shareholder equity, right? It could be a combination of those two things, but nonetheless, you have to decide how we're going to pay for it, right? And we're going to talk a lot about that over the next 4 weeks. And then finally, working capital management. How much working capital, daily needs, do we require to keep this particular project running on a day-to-day basis? Okay, how do we manage the day-to-day finances for the firm? So when we talk about the different types of organizations that an individual or a group of individuals might look at forming when they're discussing creating a new company, there's three major types. All right, there's a sole proprietorship, there's a partnership, which can be either a limited partnership, general partnership, or there's the corporation. Okay, and when we talk about corporation, there's two different types of corporations. We have an S corporation and a C corporation. Okay, and we'll talk about some of the advantages and disadvantages here in the next few slides. So when we think about a sole proprietorship, it's exactly what the name implies. It's just you. Okay, it's the easiest possible organization to start, right? There's very little regulation around it. You can go to the Maryland Department of Labor in less than 5 minutes. You can establish your own sole proprietorship. It is very, very simple. The money that comes in the door flows directly to you as the owner, all right, as personal income. Therefore, it's taxed only once as personal income. Okay. The problem with sole proprietorships is twofold. Really, it's a limited life. It dies with you. When you pass away, that's the end. You don't get to transfer it to anybody else. Okay. The second big disadvantage is that there's unlimited liability, okay? If you are selling a product that is not or does not have the potential to cause harm to somebody, maybe it's not that big of a deal, okay? But if you're selling a product or giving advice that might have the possibility of causing harm to somebody, then this is a problem, because all of your personal assets can be sued. If you make a mistake, if you make a widget that goes into a car and that part fails and it causes the death of 2 people, you and your entire life, your entire world can be litigated against. Okay, so there's unlimited liability in a sole proprietorship, and there's limited life, right? It dies with you. That's it. The other problem is that it's difficult to sell, right? Because it's hard to value the sole proprietorship. How do you go about valuing your own intellectual capital that goes into your business? How much are you personally worth to the revenue of the firm because of your own knowledge and expertise that you bring to the company? Okay, so the sole proprietorship, easy to start, very little regulation, but there's a limited life and unlimited liability. Then we get into partnerships, right? Generally, partnerships are 2 or more owners, okay? Both owners are putting in capital to the business, okay? So you're splitting kind of the capital cost of starting and running the company. They're also really easy to start, maybe not 5 minutes with the Department of Labor, maybe 15 minutes, okay? And the income is also taxed once as personal income. That's a big advantage. You don't get the double taxation of your classic corporate structure. Disadvantages, all right? General partnership, limited partnership, all right? The general partners within a limited partnership, they're tasked with running the business every day, okay? They are the ones who are making the management decisions, okay? They have unlimited liability. The limited partners, on the other hand, they inject capital, right? They're the ones that are kind of financing the business itself, okay? So their liability is limited simply to what they've put into the business. In return for that limited liability, right, the limited partners don't have a say in what goes on every day, all right? They're a silent partner. So the GPs make all the decisions and have the liability associated with the business. The limited partners inject the capital to run the business, but are only liable for the amount of money that they've put into the business to start. It's challenging to transfer a partnership simply because it involves sometimes 5, 10, 15 different limited partners that would all then have to agree upon a transfer of ownership, okay, or a buyout of owners that might want to leave the partnership. So it's a little more challenging to transfer ownership within a partnership agreement. So the key takeaway here is limited partners have limited liability to what they've injected into the business. General partners are responsible for running the business, managing the day-to-day, and they have unlimited liability when it comes to the potential legal aspects of the business. Okay. Corporation, and this is what most of you are probably most familiar with the companies that you work for, right? There's limited liability. You know, if you work for Black & Decker, you know, and Black & Decker gets sued, they're not going to be coming after you. Okay, so there is limited liability in that respect. Has unlimited life. The company can exist forever. You elect a board of directors, you elect new CEOs, and the corporation itself exists into eternity. Right? There should be a separation of ownership and management, meaning you have shareholders, okay, that are responsible for electing the board of directors, shareholders that are responsible for voting on certain items that relate to the company each year, and then you have the management that is supposed to listen to the shareholders and do what the shareholders ask and make decisions for one purpose and one purpose only, and that purpose is to maximize shareholder wealth. That's it. You're CEO of your company, whoever you work for. That is his only job or her only job. That is it. Maximize shareholder wealth, period. Okay. And if they have other incentives, it's wrong, because they exist for one purpose and one purpose only, and that is to maximize the wealth of the people who own the company, and those are the shareholders. Okay. And if you work for this company, Black & Decker, Legg Mason, T. Rowe, whoever, Wells Fargo, and you don't own company stock, right? And you're not being matched with company stock within your 401k, you're not a shareholder of the company. But your job is still to maximize the wealth of the people who do own the company you work for. Okay, corporations are easily transferred, signature on a piece of paper, all right? And it's really simple to raise capital, right? Because when you've established yourself as a corporation and you have financial statements that are regulated by the SEC and by GAAP, the generally accepted accounting principles, okay, and you have proven that you have a history of paying your bills, you get access to debt, access to capital that you would otherwise not have access to if you were simply a sole proprietorship or even an LLC or an LLP. One of the disadvantages, two kind of disadvantages of a corporation are, first, there's double taxation. And we'll see this when we get to Excel here in a little bit, all right? The company itself, all right, pays income taxes. You have revenue that comes in, you have expenses that get knocked off, you have some depreciation, maybe you pay interest on some debt that you owe, and then you finally get your tax bill and you have to pay taxes, and then you have net income at the bottom. Well, then there's a management decision that says, now that we've got all this net income, should we pay dividends to our shareholders? Well, that's a great thing to do, all right? So we're going to pay some money out to shareholders. Well, the shareholders who receive a portion of that net income in the form of a dividend, you have to pay tax on that, okay? Whether that's 12% or 15% depends upon your tax bracket, but you've got to pay tax again on money that's already been taxed. So we call this the double taxation fault of corporations. And the second disadvantage that's not listed here is that it's just more costly to set up a corporation. You have to add different departments to your organization, the Treasury Department, the Accounting Department. You have to add your Sarbanes-Oxley compliance folks, okay? You have to add additional infrastructure within your business to handle the dividend payouts, okay? So it just adds another layer of cost to your business by forming a corporation. But if you are a large company, those costs are far outweighed by the advantages of having a corporation. Okay, your ability to grow kind of into eternity, transfer ownership, and access to capital in the financial markets far outweigh the additional costs that you might have to incur once you reach economies of scale. Okay, so what are the goals of financial management? All right, and I want you guys to think about this. All right, and I've already given you a little bit of a hint, right? So is the goal of a company to maximize profits, right? Meaning net income, right? Is that our goal? At the bottom line, is our goal to deliver as much money as possible to the bottom line? Or is our goal to minimize costs, right? Do we run a lean organization? Okay, we sell our products at a competitive price, and we are super hyper focused on cost saving measures, right? Or is our goal to dominate the market? Do we want to own the market that we participate within, all right? Or the fourth bullet, is our goal to maximize the current value of the company's stock? Okay, so I'm going to stop there for a second. All right, and I'm going to open it up for chatting now, speaking if you'd like to, in terms of what do you think the goal of a corporation is? Is it one of those four things? Is it something else? What is the goal of a corporation?
Morgan here. I think the goal is maximizing the value of the stock. And I think the first 3 bullets are just like, you know, strategies to do that, right? Do we go after profits? Do we minimize costs? Or do we, you know, go after market share as a way to increase the value of the company stock and shares? So that's my thoughts.
Okay. Excellent observation. Because the 4th bullet point, if we believe in efficient markets, right? And we believe that the value of a stock is completely made up of all of the value within the firm, then it should be the goal of management to increase the value of the stock price, right? Because at that point, if that's one single indicator that we're kind of doing everything we need to do right, okay? And it's the one piece of information that all investors have access to 24 hours a day, 7 days a week. So if we are maximizing the current value of the company's stock, then we should be focused on maximizing our profits, whether that's through additional revenue or whether that's through the 2nd bullet point of minimizing our costs, operating more efficiently, or whether that's through the 3rd bullet point of dominating a market, okay? If we believe in efficient markets, then our stock price should be reflective of the value that we're delivering to the shareholder. And as that stock price goes up, we'll talk about share buybacks and whether or not those are a good thing or not here in a few slides. But aside from that, if the value of the stock goes up, then we should be doing all of these things, okay? Now, the final major bullet here, does this mean we should do anything and everything to maximize owner wealth? This is more of an ethical question, you know, what's legal versus what is right, okay? And there are many, many ways through SPVs, SPEs, off-balance sheet transactions where we can artificially add value / wealth to the corporation, but is that actually ethical to do or not? If you're interested, you can watch The Smartest Guys in the Room, which details the rise and fall of Enron, you know, back in the early 2000s. It's fascinating. I actually was working in Houston, living in Houston when all of that went down. As a matter of fact, some buddies of mine, every March when Enron would, you know, pay out their giant bonuses to all their traders, we were working in the chemical plant for BP. And we'd literally like grab our lunch and we'd just drive downtown to the big Enron building and sit outside in the big park that was right across the street from the building and watch tractor trailers of Lamborghinis and Bentleys and Ferraris get delivered in front of the building for all of the traders that had just gotten all of their $500,000 or $600,000 bonuses. And they all bought nice fancy cars. So there's lots of ways to increase shareholder value, but is it legal versus what's right? Is it legal to do it, but is it right to do it? And that's going to be a decision that you guys are faced with time and time again throughout your careers. And that's going to be a personal choice that you have to make as to how you go about handling those specific situations. So herein lies the problem. Okay, and we call this the agency problem. All right. So we have this relationship that exists within an organization. All right. We have these folks called principals. All right. And they hire an agent, right, to represent their interests. All right. In terms of a corporation, we as stockholders, as shareholders, we are the principals. We are responsible for hiring the managers, the board of directors, the agents to run the company, okay? We get to vote on who sits on the board, okay? It is part of our responsibility as shareholders to put our vote in as to who sits on that board, all right? We're the principals. It's our job to hire and fire the people who run the company, okay? The problem becomes, and this is what we call the agency problem, when there becomes a conflict of interest between the principal and the agent, right? When there is an incentive structure that exists to benefit one side more than the other side, right? So this gets into our conversation around how do we go about compensating the C-suite, right? Anybody know within your company how your senior executives are compensated? How do your C-suite managers get compensated? How do they get bonused? Anybody seen what your CEO, what your CFO, what your CIO, anybody seen what their salary and bonuses look like?
Don't they get like stock options, or sometimes get stock options?
Yeah, some of them do get stock options. And if you're getting a stock option, okay, what is your incentive at that point?
Maximize company value or the stock value.
Maximize stock value. Okay, so there's a slight difference between what the two things that you just said. Maximizing stock value can be different than maximizing actual shareholder wealth. Okay, and we'll talk about share buybacks in a second, how the math, just simple math, can pump a stock price up without actually changing anything fundamental about the business. Okay, so yeah, a lot of senior executives get bonused with stock options, which means they have a big incentive to pump the stock price up, whether it's simply mathematical or whether it is truly creating additional shareholder wealth. Okay. The point here is that those objectives, and I encourage all of you to go to your company's SEC documents and look up the managerial compensation for your senior executives. As a matter of fact, I challenge you one step further, send an email to their administrative assistant and ask to visit with them about how they're compensated. Okay? Hold them accountable for how they're compensated. Maybe one of you will do that, and I would love to hear about it, because a lot of them will say, some of them will even say, I don't really even know. Okay, but that's kind of the problem. There is an incentive, okay, that can be in conflict with actually creating shareholder value within your firm. Okay, and as an employee of that company, and most of you probably do have company stock within your 401k, meaning now you are a shareholder, you are well within your right to understand more about how the senior executives and management are compensated within your firm. Okay, because quite frankly, it might all be fine. And it will also allow you to understand how you can do your job better to further increase shareholder wealth within the firm. Okay, so I'm not saying that all of your companies are doing something wrong and they're all misaligned. I'm just saying, find out, do the research, figure out what are the performance metrics for your senior executives and how are they compensated. Okay. When a misalignment occurs, that's when we start dealing with corporate control. Okay. Einhorn was an activist investor from Greenlight Capital a number of years ago, and within the Apple financial case that you guys are going to start reading, it talks about him. Okay, Apple was faced with a big decision. How are we going to go about allocating this $100 billion plus cash pile that we had scattered around the world? How do we go about efficiently allocating that capital? What do we do? Okay, and if companies aren't paying attention to how they're allocating that capital, you get people like David Einhorn, activist Carl Icahn, all right, who come in and try to take over the board of directors in order to force a change to give some of that profit back to shareholders, right? Distribute the wealth back to the people that created the firm and who have been supporting the firm. Okay, so we get into this idea of corporate takeovers when there comes a misalignment between the performance of a business and the way that the executives are incentivized. Okay, so, like I've said before, Yahoo Finance is actually pretty good. The rest of Yahoo sucks. I'm not even sure why it still exists anymore, but I'm glad they kept Yahoo Finance because it actually still is pretty decent. So between, Yahoo Finance and Morningstar, Market Watch, there's a wealth of information out there that you can do research on to figure out how your executives are compensated. Go to sec.gov, the Securities and Exchange Commission, sec.gov, and look up the financial statements for your company. And we'll do that over the course of the next couple of weeks to see what they look like. And we'll dig into what some executive compensation is for the folks that you work for, okay? Because it's important to understand. So when we think about the cash flow from a firm and how things move from one income statement to the other income statement, okay? We talked last week or earlier tonight about corporate structures. Well, how does a company even go about getting access to equity? Well, they go through the IPO process, the initial public offering process. So over here, kind of on the right-hand side, okay, they issue shares to the marketplace, okay? Those shares get issued. You have a group of underwriters, okay, book runners that go out into the corporate world, and their job is to sell all of the shares being issued within that IPO, okay? The firm then collects all of that money from the sale of that new stock that got issued. Once they get that money in the door, they invest in their assets. They buy new equipment. They buy the desks that you sit in. They buy the computers that you work at. They buy the infrastructure that is allowing you to work from home right now, okay? So they put money into the assets of the firm. And then those assets deliver money. You are an asset to the firm. They put money into you through paying your salary. It is your job. If you're on the sales side, it is your job to bring revenue in the door. If you are a cost center to the business, it is your job to do your work as cost efficiently as possible. Maximize revenue, minimize cost, okay? So we get cash flow from our assets, all right? Our physical assets, our tangible assets, okay? Once we get our cash flow from our assets, we have a couple of things that we do with it, all right? We pay money in taxes, all right? We got to give the government what the government is owed, all right? If we financed some of our business with debt, we owe interest on that debt to creditors, right? And then finally, we put money back into our firm through what we call retained earnings. Whatever is left over after we've paid our shareholders, after we've paid our creditors, after we've paid the government, if there's anything left over, we call that retained earnings. We're retaining what's left over and we're pumping it back into our business in the form of a reinvested cash flow, okay? So we can save money, share money, spend money. All right, that's the basic premise behind the financial statements that we're going to talk about in the second part of tonight. So when we talk about the financial markets and how companies go about accessing money, there's a debt market and there's an equity market. You go through the IPO on a primary market where you've got those book runners and underwriters out there selling the initial allotment of shares that are priced at a certain price point, okay? And then once those shares start trading on the open market after they have a big wine and dine shindig in Wall Street and they get to ring the bell, you know, on the NASDAQ, then we move to the secondary market where everyone else gets to buy and sell. The brokers in the middle match up the buyers and the sellers, and that's what dictates the price in the market, all right? So when we talk about the ethics surrounding corporations, okay? And we think about this first question here. Is it ethical, and I want comments on this, for tobacco companies to sell a product that is known to be addictive and a danger to the health of the user? And is it relevant that the product is a legal product?
Professor,
Yes.
this is Annalise speaking.
Annalise?
Yes, this might just be my own, because I feel strongly about this, but I don't think that it's really ethical for tobacco companies to sell the product. at all. Whether I think my mindset probably is because it has to do with the legality of it, but also just because I know, people who have become very addicted to it, and I think the benefits aren't nearly as strong as the cons of the product. So I would say no to that question.
So as in it's not, even though it is illegal to produce and sell tobacco products,
Mm-hmm.
your position is that it is unethical for these companies to do it because they know good and well that it can be an addictive substance.
Correct. And I think, other people would probably argue that it's on, the person taking it to know, what their limits are and how not to become addictive. But I also think that there's a responsibility of the company themselves to, kind of put it on them as well and say, we know this about, our product. If we're going to produce it, how can we, as a company, kind of limit that exposure?
And I think that there's a great movie, and if you guys haven't seen it, you should definitely watch it. It's called Thank You for Smoking. That kind of goes through this exact question, and at what point do you begin to infringe on people's rights to do whatever the hell they want to do?
Right.
If somebody wants to smoke cigarettes, we do live in the United States of America, and as long as we are being transparent with the dangers associated with, whatever, smoking cigarettes or drinking too much alcohol when you're pregnant, or, skydiving or scuba diving to, 50 meters like I used to do. I think you're right. Like, I think there's a transparency that has to exist. Anyone else like to comment on that?
This is Morgan. I was just gonna kind of counter her argument that, I think it is ethical for them to sell it as long as they're completely honest. And you see that there's now labeling and packaging associated with risky products, with alcohol, with tobacco, certain vape products. But I do believe that people should have the choice, right? And if we start with tobacco products, where does it end? Does it then go to wine and beer and alcohol, and then any kind of risky behavior? People die jumping out of planes, skydiving, just like you said. But where does it end once you start that way? Where does it end, right? So yeah. That was the point I wanted to make. Slippery
slope, right? But again, right. There's no right or wrong answer, and I think it's great conversation, and it's things that within your own businesses you ought to look at the products that your company sells. You ought to look at the way that they go about marketing them. I remember when I was working for Constellation many years ago, we were producing some graphs for a Wall Street analyst presentation, and the slope of the graph wasn't quite as high as what management was hoping to convey to the analysts, and they wanted us to adjust the scale of the y-axis to make it look a little bit, exaggerate the slope, even though it wasn't as high as what it was going to look like. And I just told them, I said, we can't, like, that would be misleading the investors if we did that. And then they said, well, just take all the titles off of the axes, and we'll just explain it when we talk. It's that kind of the ethics that go around with some of the decisions that we all have to make in the businesses that we work for. Okay, so what I'd like to do now, if we could, and this is the first time that I've done this, so kind of bear with me. I'd like to go into some breakout rooms, and we have a mini case that I put out there on Moodle, okay, that is regarding a particular cake company. It's called the McGee Cake Company, and they were a small sole proprietorship, and they have started to grow quite significantly. All right, and what I'd like to do is just maybe break everybody out just randomly into breakout rooms. and I'm going to go into 5 breakout rooms, and you're all going to get reassigned into a breakout room. So we'll have 15 on, and there'll be 3 in each room. What I'd like for you to do is I'd like for you to just read the case and then talk a little bit about the 3 questions that the folks who run the McGee Cake Company are facing right now in terms of, do they stay a sole proprietorship? Should they convert to an LLC? What are some of the advantages and disadvantages? So we'll spend about 5 minutes in the breakout rooms, and then we'll come back and we'll have a little chat. So I'm going to go ahead and push this button here and see what see what happens. Okay, and all the rooms are now open, and so you are free to join your breakout rooms now and spend 5 minutes. All right, spend 5 minutes just kind of chatting a little bit about the case, and I'll check in with each of the rooms, joining in randomly just to kind of see how you guys are doing. And then we'll kind of rejoin back in here in about 5 minutes.
guess we were a little premature.
Nope.
I guess that's what.
Oh.
Sorry, guys.
Oh, well.
We finished, so we just came back into the main room.
Cool, bro. I'm going to hop back into group 5 real fast. Oh, you guys are already back
I think
in.
we are group 5. Yeah.
Cool. All right, cool. So I'm going to leave it open for about another 30 seconds. Then I'm going to close all the rooms and everybody will come back in. Do you guys have any questions?
No, I mean, we pretty straightforward, I think.
Yeah, cool. I'm going to go ahead and close everything.
Okay.
That worked out pretty well. Have you guys used breakout rooms in any of your other classes?
Yeah, pretty much every class. I mean, 30 minutes each time, just case studies or group work or whatever.
Yeah, that's good. Now we're closing here in 30 seconds. Drew, who do you work for?
I work for Black & Decker.
Black & Decker, okay.
Yeah.
Jared, Kate, what about you guys?
I work for District of Columbia government actually right now.
All right.
Public sector.
Oh,
I work for a company called Revent. We're a healthcare.
Professor, we were kind of struggling. Maybe you can elaborate on this later, but we were kind of struggling with the difference between an LLC and a corporation, and when you would choose one or the other, which may be the point of this exercise.
yep, you got it. We'll
Okay.
talk about that here in just a second.
Okay.
Cool. All right, so I think it looks like we're all back. Okay. Would somebody like to chat a little bit about the first question, advantages and disadvantages of changing the organization from SP to an LLC?
Yeah.
Hey, this is Libin from. Oh, wait, go ahead.
No, Libin, go ahead. Sorry.
Yeah, sorry, Will. This is Group 3. So a couple advantages that we had was one of the big ones that they have is the they can avoid the double taxation if they go to the if it runs it like a partnership rather than a corporation. And then the disadvantage that we mentioned was the restriction of liability to the business itself when compared to the whole business and compared to like your personal assets, basically. So those are the two advantages and disadvantages that we mentioned in there. We're still focusing on question one, or are we choosing which one we chose as well?
Yeah, no, that's good. I mean, those are all good observations. I would say that the, when in terms of the cake company growing, if they're small and they're more local, the risk or the liability associated with, some sort of litigation is pretty small, right? But the more that they start to grow, the more they grow internationally, the more they get into more food stores, the probability of something happening with their food. Okay, think about the Loyola juice fiasco a number of years ago, all right, where they didn't pasteurize any of their juices, right, because it's all natural, but they wound up having cases, I think, of salmonella, right? And if it had been more local sales, it may not have been that big of a deal. With this cake company, if you're an LLC, you are shielding all of your personal assets from the possibility of litigation, so as they're growing, they need to have that kind of protection, even if it costs them a little bit of money to put that new structure in place. So good job. Yeah, great. That's exactly right. Question 2, advantages, disadvantages of changing the organization from an SP to a corporation instead of just an LLC. So going one step further.
So our group had said the advantages of forming a corporation is that you have unlimited life and it's easier to raise capital. However, one of the disadvantages is then you're exposed to double taxation.
That's right. Okay. So I couldn't have said it better myself. That's pretty much exactly right. And the only other disadvantage that I would say is that it's even more costly to put a corporation in place, right? Because in addition to the added regulatory filings from an accounting standpoint, you have to have a board of directors, you have to have meeting minutes, you have to have a whole nother infrastructure of employees to handle the extra admin costs associated with going to the corporation level that you don't have to necessarily have if you're an LLC. Okay, so think about it just in terms of cost. You've got the cheapest solution which is an SP, but it's also got unlimited liability. You've got the LLC/LLP, which is a little more expensive, but provides some limited liability protection. It's a little bit more difficult to transfer ownership. And then you've got the corporation, the most costly of all, double taxation, but unlimited life, right? So everything comes with a trade-off. All right, finally, number 3, what do you recommend and why?
Professor, our group recommended to go with the corporation, even though it is more costly. We think primarily for the sole purpose of the growth stage that they're in, the company needs a lot of capital, whether that be for ramping up production or for a facility purchase. And since they are so successful at this moment, even though it would be more costly than doing an LLC, we think that they can afford that.
I think that's a fantastic answer, because if they're in this hyper growth mode, right, and they're already looking at expanding into all these different food stores, okay, they might as well just bypass the middle structure of an LLC, go straight to the corporation, pay the cost once to convert from an SP to a corporation, and then continue that hyper growth and not have to deal with translating all of that LLC into a corporation at a future date. So they actually, even though it's costlier, they avoid additional cost by having to not go through the whole LLC process. Okay, so I think I would definitely agree with you on that one, Annalise. Excellent job. Okay, awesome. So let's go ahead and are there any questions about, chapter 1? Just general corporate entities, corporate structures, because what we're going to talk about from here on out is strictly corporations. Okay, that's pretty much where we all work. It's what we're all going to be familiar with. When we go and do research on financial statements, we're going to be talking about corporations, but it's very important that you understand the differences, because if you are thinking about starting your business one day, you know, it's important to understand the advantages and disadvantages of the entities that exist. Okay. So I'm going to go ahead here and we're going to fire up chapter 2 and get into the meat of this lecture. Let me see here. There we go. Sorry, I was on the wrong slide. My bad. Okay. So everything that we're going to talk about starting right now until we get through the midterm, okay, everything is going to build upon itself. We're going to get real simple tonight in terms of financial statements. We're going to build out the financial statement starting next week. We're going to start working on how they translate from one to the other over the next couple of weeks. We're going to take a simple financial statement that deals with 1 year, and we're going to extrapolate that out for 10 years on a 10-year pro forma. The Heritage Doll case is exactly what we're going to use when we get to that point. Okay, we're going to talk about discounted cash flow analysis, but we can't get to that point until we understand the basic mechanics of the financial statements that exist. All right, and those financial statements are the income statement, the balance sheet, and the cash flow statement. Okay, we're going to talk tonight about what's the difference, all right, between, and hold on one second, my chat room just evaporated here. So that I can see, there it is. Okay, here we go. There we go. Okay. Oh God, come on, man. Seriously? Okay. We're going to talk about what the difference between market value and book value is. And this is extremely important for you to understand, because if you're going to make a mistake on some of the calculations, you're going to make a mistake on forgetting this key term called depreciation. Right? So if you're already an accountant, you've got a little bit of a leg up because you know that it's a non-cash item and you've got to add it back in when we start talking about real cash. Right? We're going to talk about accounting cash flow, and we're going to talk about financial management cash flow. And they're not the same thing. Okay? One, we have to put into regulatory filings. The other tells us how much money we actually have to run our business and how we're going to go about allocating capital. Okay, sorry, I'm moving a few screens around over here. Sorry about that. There we go. And okay, all right, we're going to talk about tax rates. And I left this bullet in here because even though back in 2017, there were some changes made to the tax code that simplified corporate taxes, right? So now corporate taxes are taxed at a flat 21%. Super simple, right? But that's not how your personal taxes are calculated. Your personal taxes are calculated on a marginal basis, meaning you're taxed on the next dollar that you earn. And we'll talk a little bit about the differences between the two of those. And if you'd like to have a conversation around whether or not, you know, you'd prefer to have a flat tax versus a marginal tax versus a progressive tax versus a value-added tax, which is a tax based upon each incremental value added along the supply chain of a product, I am more than happy to have that conversation in class because I think it would be a really good one. And then finally, by the end of the lecture tonight, you will have been able to determine what the cash flow that gets produced by the assets that the firm has. And this is an extremely important number. That is a measure of the real cash that the firm has access to. All right, so we're going to talk about the balance sheet. We're going to talk about the income statement. We're going to talk about taxes, and we're going to talk about the cash flow statement. So now is a good time, if you've printed out those handouts that I put up on Moodle that I emailed you about, now's the time to get them out and start making some notes as we go through this. And we're going to kind of be cutting back and forth between PowerPoint and Excel so that I can show you how to build the Excel file that you're going to want to build and keep consistent so that you don't have to rebuild it every single time you get questions about these financial statements. So first of all, you know, what is the balance sheet to begin with? Okay, in short, it's simply a summary, a snapshot as of a given point in time of all of the things that we own and all of the things that we owe. That's it. Okay, there's two sides to the balance sheet. Okay, on the right side, you have the assets. On the left side, you've got the liabilities and equity, right? And both sides have to balance, right? So the assets have to equal the liabilities plus equity. So assets equals liability plus equity, right? That's what we call the balance sheet identity, right? When we talk about our assets, right, we will list our assets in the order of liquidity, right? And when we say liquidity, it means the ease of converting to cash, right? So in the chat room or verbally, however you guys would like to talk about it, what do you think the most liquid asset that a firm has is? Cash. Thank you, Annalise. Cash is cash, right? Cash is king. It is the most liquid. Therefore, it's the first thing that's listed, right? And then we get into things like accounts receivable, right? We sold product. Our customers are on some sort of payment terms. They get to pay us in 30 days, right? But it's cash that we have not yet received, but that we expect to receive at some future point in time, right? So that's like the next most liquid thing. And then if we're a manufacturing company, we have things like inventory. We've got product that we've already made sitting in a warehouse waiting to be sold, okay? Once we sell it, it either moves to cash if they don't have payment terms, or it moves to accounts receivable and then gets converted to cash. All right, so we've got cash, accounts receivable, inventory, okay? And we call those three things current assets, okay? The things, the assets that we have that are easily converted to cash within the next 12 months, okay? When we talk about current assets or current liabilities, we're talking about a 12-month time frame, okay? Now, if you're in finance right now and you're in accounting right now, okay, you know good and well that there's a whole lot more that goes into current assets than just cash, AR, and inventory, okay? But for the purpose of this class, right, that's all we're really going to be talking about. You might see another line item that says other current assets, but it's pretty self-explanatory where that fits, okay? So we're not going to get into, you know, short-term investments or other current assets that are outside of those four items, okay? The point here, and this is extremely important, is that the assets are listed in order of decreasing liquidity. And we don't mean things that can be sold by destroying value, all right? Yes, if we have a chemical plant, we've got a bunch of equipment out there, right? If we needed to convert those pieces of equipment into cash, we could probably find somebody to buy it, but we'd have to sell it for pennies on the dollar. So we're not looking to fire sale things. We're looking at easily converted to cash without destroying value. Okay, you could go out and sell an illiquid investment in the market for a loss if you needed to convert it to cash, but you would have destroyed value. So we're ordering it in the order of liquidity without destroying value. So cash, AR, inventory, current assets, followed by PPE, plant property equipment, AKA net fixed assets. And we're going to go through this here in a second, so don't worry. So when we think about the balance sheet, this is kind of what it looks like. We've got the value of our assets on the right side. We've got the value of our liabilities and shareholder equity on the right-hand side of the balance sheet. We've got our current assets, our liquid assets, things easily converted to cash. Then we've got all these other assets that are our PPE, our fixed assets, and our intangible fixed assets, all right? And I'll get back to that one in just a second. But the sum of those current assets and intangible, tangible fixed assets gives us our total assets. On the liabilities side, we have things that we owe to other people, okay? Suppliers of ours that we owe money to for the product that we bought for them, okay? So accounts payable, all right? And we'll talk about whether that's if an increase in accounts payable or a decrease is a source or use of cash. We'll talk about that next week. We've got accounts payable. We've got notes that are due, debt that's due within the next 12 months, notes payable. So accounts payable and notes payable are our current liabilities. And again, you finance and accounting folks know there's a lot more that goes into that, but we're going to keep it simple. Okay, so accounts payable, notes payable equals current liabilities. Then we have long-term debt, okay? Financing that we've taken on to grow our business, all right? Debt that has maturity of longer than 12 months, long-term debt. So the sum of our current liabilities and the sum of our total long-term debt is our total liabilities side of the balance sheet. But that's not all we owe, okay? We've got debt that we owe. We've got suppliers that we have to pay, banks we have to pay. But guess what? We also have shareholders, and we have to pay the shareholders. The shareholders are a liability to the firm. We owe them money. The shareholders have value. They have entrusted us to run the business. They have bought stock in our company, okay? We have operated our business for years, and the money that we've kept for ourselves every year flows into what we call retained earnings, which is in shareholder equity, okay? So we don't just owe money to the banks and owe money to the suppliers that we have a liability on our balance sheet to the people who own the shares of our company, okay? So right side assets, left side liabilities and owner equity, shareholder equity, equity. I'm going to use all of those interchangeably, okay? And both sides have to balance, okay? And then we have this difference, what we call net working capital, all right? The difference between our current assets and our current liabilities, right? And what does that even mean? Basically, it says, do we have enough money to cover our obligations for the next 12 months? Okay, if we have positive net working capital, all right, current assets minus current liabilities equals net working capital. If we have positive net working capital, it means that our assets are generating enough money, okay, to essentially cover, and then some, the liabilities that we expect to have over the course of the next 12 months, okay? So we want to see positive net working capital. It means our assets are working efficiently. It means our business is working efficiently. It means our accounting department is doing a really good job converting that accounts receivable into cash. Our sales guys are doing a good job converting that inventory into accounts receivable and subsequently into cash. So positive net working capital is a good thing for a firm, okay? So net working capital equals current assets minus current liabilities. And when we get into the Heritage Doll case, okay, and they're looking at expanding one of their product lines, you're going to see the change in net working capital required simply because you're thinking about putting the new product in place. So all of this will kind of come full circle as we work through the Heritage Doll case. If you have questions, feel free to hit the chat room. I've got it up so I can pay attention to what's going on. Okay, bottom line here. Assets equals liabilities plus equity. That's what you need to know. Okay, so net working capital, current assets minus current liabilities. We talked about it. When the cash flow to be received over the next 12 months exceeds the cash outflow, we've got a positive net working capital and we have liquidity. Okay, it better be positive in a healthy firm. If you've got negative working capital, not that you can't have negative working capital from time to time, but in general, you do need to have positive net working capital or else you're going to go insolvent. Okay, and again, with liquidity, this first bullet point here, really, really important to understand. The ability to convert into cash quickly without destroying value. Okay, we can all fire sale stuff, right? But we don't want to destroy value. That is the point. We want things to be liquid and easily converted into cash. Okay. So when we take a look at this U.S. corporation balance sheet, right, we can see how things are organized. And I would encourage all of you, and we're going to get into Excel here in a minute, okay? Go ahead and set up an Excel file that has exactly what's listed here, with the addition of a couple of things that I'll show you when we get to Excel to make your life a little bit easier. But go ahead and start setting up your balance sheet and your income statement, because when you start working through problems, the last thing you're going to want to have to do is spend 15 or 20 minutes setting the framework up just to get the numbers plugged in. Okay, so U.S. corporation, here we've got cash from year over to year, so 2017 to 2018. All right, they increased their cash. We've got accounts receivable that went up year over year. We've got inventory that slightly went up year over year. We have PP&E, net plant and equipment, or net fixed assets, that went up year over year. And we've got total assets for both years. Accounts payable, we can see accounts payable went up year over year. Notes payable went down. That's a pretty good thing. Long-term debt went up year over year, meaning we took on more debt long-term, not just in the next 12 months, but a longer maturity than 12 months. We can see we had some common stock. So the value of our stock went up in the marketplace. We'll talk about retained earnings. So put an asterisk next to that. We'll talk about what that means. And we got total liabilities and owner equity. And you can see for each year, the assets on the left balance with the liabilities and equity on the right. Now, let's take a step back for a second and let's look at these numbers. And let's think about it from a cash flow standpoint, okay? And think about it in terms of a source of cash versus a use of cash. Right? This is an important thing that we have to understand. All right, I'm gonna give you a softball here. Cash goes up year over year. Source of cash or use of cash? Oh, this should have been. There we go. That should have been a much faster response. Source of cash. Cash went up. Source of cash. Okay. Accounts receivable. Source of cash or use of cash if we went up in accounts receivable year over year?
Use.
Who said use?
This is Mark.
Mark, why is it a use of cash if accounts receivable goes up?
Because you're not bringing in any additional cash, and you're raising just additional cash to be received in the future. So just what you're using, if you keep cash fixed, then you're using the same amount of cash to produce, to ultimately produce higher cash you need to receive.
Exactly. Okay. When accounts receivable goes up, it means that it's taking you longer to get your money, right? It's taking you longer to convert that money into real cash. So when accounts receivable goes up year over year, it's taking you longer to get that money. Your days sales outstanding is increasing, meaning you've got to use your other cash to cover your other expenses. So when AR goes up year over year, you are correct, Mark. that is a use of cash, okay? And what about inventory? If inventory goes up year over year, is that a source or a use of cash, you think?
Also a use.
Use. Who said use?
I think two of us are talking at the same time. But
Jennifer,
I think
yes. Thank you, Jennifer. Yes, it's a use of cash, right? We used our hard-earned money to make that product that's now just sitting in a warehouse waiting to be sold, right? So it was a use of cash. Very good, right? If PP&E goes up, if our NFA, net fixed assets, goes up, it's a use of cash, right? We used cash to buy more assets that's now sitting on our books, all right? So if NFA goes up, that's a use of cash. On the liabilities side, let's think about accounts payable. If accounts payable goes up, like it did in this example, source or use of cash? Any ideas? Okay, if accounts payable goes up, all right, that means we're taking longer to pay our bills, which means we're keeping more of our cash to ourselves, right? So that is a source of cash. So if accounts payable goes up, we're managing our cash more effectively. Maybe we negotiated better terms with our suppliers, okay? And we're taking longer to pay our bills, meaning we're holding on to our cash more for a longer period of time. Therefore, it's a source of cash, right? Notes payable, self-explanatory. If it goes down, it's a use of cash, means we paid down short-term debt, okay? Long-term debt, also self-explanatory. If it's higher, it's a use of cash. Wait a second, is it actually a use of cash? Any thoughts? Long-term debt, if long-term debt goes up, is it a source or a use of cash?
Source.
Source of cash, because we went to the bank and we said, give us more money. Okay, so even though when long-term debt goes up, we went to the bank and they gave us more money. So we had more cash coming in the door, right? Translates into higher interest payments on our income statement. But when long-term debt goes up, that's a source of cash. When long-term debt goes down, that's a use of cash because we paid off debt. Okay, all right. We're going to talk more about all of the source and use next week, but I wanted you to at least get a feel for what it looked like. Okay, so the balance sheet, all right, it provides us with what the book value, the accounting value of what our assets and our liabilities and our equity are, all right? But more often than not, market value and book value are two very different things, right? Book value is an accounting term, right? If somebody wanted to come in and buy the firm, right, they would look at what the book value is of the firm. But then they would flush that value up against what the market looks like, okay? And the market price is simply what somebody's willing to pay for the business, okay? It could be equal to the book value, could be higher than book value, could be lower than book value. And a lot of companies make a lot of money within their business model simply trading, buying and selling businesses based upon their market to book ratio. Okay, so why are they different from one another? It's really simple. The market value is just what somebody's willing to pay, basic economics, willingness to pay, right? The book value is an accounting term. How much did we pay for the assets? What was the depreciation on those assets? And how much accumulated depreciation have we had? That is our book value of the firm, okay? So there's a big difference between market value and book value, right? So when we talk about what's most important in our decision-making process, what do you guys think? Think market value or book value is most important?
Market value.
Okay, market value. Will says market value. It's market value, right? Because that is most representative of our current cash flows. All right, book value is fine, like it gives us an idea, like a directional point, but you know what? It doesn't really tell us how the business is generating cash, right? It kind of just tells us, from a regulatory standpoint, what the business is worth, but it doesn't tell us much about what somebody's willing to pay for the business, okay? It's more reflective of the cash flows that are currently occurring. Right? So when we look at, and I've been meaning to change this, like I should have changed it last semester because I'm more of a Star Wars guy than a Trekkie, to be honest with you. We look at things like net working capital and net fixed assets, debt and shareholder equity, book value versus market value. And we can see that in the case of this company, the market value is greater than the book value, okay? Meaning that the market is valuing the current cash flows of the business at a premium to what the book value, the accounting value says the firm is worth, okay? So when you look at companies that are traded on the markets and you see a market to book ratio that's higher than 1, that's what that means. And if you see companies that are trading below book value, it means that if they were to sell everything on their books, okay, at book value, that is worth more than what the current stream of cash flows is delivering for that firm, okay? So we tend to call those like distressed assets or deep value assets in some cases, okay? So that's the balance sheet, all right? And I'm going to move through the income statement and then we're going to hit Excel. I'm going to show you how these things kind of come together. So it kind of bring things together for you from an Excel standpoint, right? So the balance sheet is a snapshot in time, what we call an as at 12/31, as of 12/31, okay? It gives you a snapshot in time of the valuation of what you own and what you owe. Has nothing to do with the operations that you've done. The income statement is what tells you operationally what you have done, okay? So the income statement gives you a summary of your operations between 2 different points in time. How much revenue did you bring in the door? What was your cost of goods? How much did it cost you to make that product? What expenses did you incur to go into the support of the sales of those products? How much depreciation did you have? How much interest did you pay? How much taxes did you pay? Right? So the income statement, right, starts with revenue, flows all the way down to what we call net income, bottom line. So revenue is top line, net income is what we call bottom line. Okay? And then GAAP, which is the generally accepted accounting principles, we undergo what's called the matching principle, which means that we match the revenues that come in with a given period with the expenses associated with that same period that are required to generate that revenue. All right, you don't have to worry about that too much. I'm not an accountant. I'm an FP&A, financial plan and analysis guy. God bless the accountants. I could never do what they do, but I prefer management reporting as opposed to SEC reporting. Right? So we have the U.S. corporation. Again, maybe make some notes. You've got these slides printed out. We have net sales, AKA revenues. All right. We have cost of goods sold. How much did we have to pay supply chain wise to go into the products that we sold? So if you think of an iPhone, how much did the semiconductor chip cost? How much did the camera lens cost? How much did the glass front cost? All the cost of the products that went into the eventual final product, okay, that got sold, cost of goods sold. And then we have depreciation. We have something called EBIT, earnings before interest and taxes, interest that we paid to our creditors, taxable income or EBT, taxes at 21% of EBT, and then finally net income. And when we get into Excel, I'll go through all this in much more detail. And then here we go. So at the end of this operating period, U.S. corporation had $493 million kind of left over, right? And the financial managers had to sit there and go, all right, now what do we do? All right, well, we only got 2 choices. We can do 2 things, right? We can keep everything for ourselves, and we can flow this 493. All right, and if you go back to your balance sheet, okay, this guy, okay, we can flow that entire 493 into retained earnings, okay? Or we can pay dividends to our shareholders as a thank you, and then whatever's left, we can flow that into retained earnings, okay? So management has to decide, what do we do with our net income? So net income equals dividends paid plus addition to retained earnings. Okay, that relationship right there, you need to write that down about 10 times, because if you're going to make a mistake on movement of money from the income statement to the balance sheet, that's where you're going to make it. Okay, net income equals dividends paid plus addition to retained earnings. Okay, and we're going to get to Excel here in a second, and you'll see how it all flows. Okay. We're not going to go through this right now. Next week we'll get into the SEC website, and we'll go into, we'll pull up one of your companies, whatever, you know, Black & Decker. We'll pull up Stanley Black & Decker, and we'll look at the income statement and balance sheet and the management discussion and analysis around Stanley Black & Decker, you know, and we'll go through how to research your own company's financial statements. And you should do it. Like, there's some interesting stuff in there that you probably didn't know, and you probably look at some of the salaries of the people that you know that work at the company, and it'll blow your mind. Taxes, super simple now, okay? 21%, that's it. All right, once we get down to earnings before taxes, the tax calculation is simply 21% of that number, all right? It used to be marginal, all right? Meaning you have these different tax brackets. And if your income falls within a certain range of each of these tax brackets, the money that was earned within each one of those brackets got taxed at that rate, okay? If you were taking my undergrad class at Loyola and we were talking about personal finance and your taxes, you'd have to go calculate what your actual marginal tax due was based upon different marginal tax brackets. But from a corporate standpoint, the Tax and Jobs Act of 2017 simplified everything. Right, 21%, done. All right. So I'm going to stop here for just a second, because we're going to get into cash flow. But what I want to hop over to Excel. I want to show you how all these things kind of come together with the U.S. corporation balance sheet and income statement. Okay. If you guys can't see this, or if it's too small, please let me know. I'm going to go ahead and make it a little bit bigger. Now it's too big for me. Okay. So what I'm going to encourage you to do, right, is set up this file, right, so that it's easily reproducible, because it's not going to be anything that you're tested on, anything that you see within homework is not going to be anything more than this for an income statement. You might have another year, you might have 10 more years going out, but in terms of the structure, it is the same. Okay, so we have revenue. So let's put in our revenue for U.S. corporations. So we had 1509. Okay, so you know, $1.509 billion. All right, we had cost of goods sold, right? So we have to remove that from revenue. The only positive number we have on this entire page is revenue. That's what comes in the door. Everything else below that is going out the door, right? All right, if you're an accountant, you know that that's not exactly accurate. Okay, there are other things that you can get credit for. For the purposes of this, everything is negative from here on out. Okay, so we have cost of goods. So we have 750 million of cost of goods, right? So we have this thing called gross margin, right? Gross margin is a really important number that Wall Street analysts pay attention to, because it kind of gives them an insight into how well is a company managing the supply chain that goes along with the products that they're selling. Okay, are they keeping their costs down? Are they able to increase price while keeping their cost the same or lower? Okay, increase in gross margin means more money flowing to the bottom line. We like to see that. Okay, expenses, the supporting costs that go along with operating a company. In this example, they don't have any, it's all rolled into cost of goods sold. So we're going to leave it zeros for now, but just know that if you see things like salaries, marketing expense, research and development, those are all costs associated with supporting the sale and production of a product, okay? Just like, I'm going to come back to Black & Decker just because it's in my head, you know, you've got a sales team that makes money and gets commissions on what they sell. You've got a marketing team that has promotions that go out to sell the new tool into the marketplace, right? That is an expense that goes along with the sale of a product. Once we take into account revenue minus cost of goods sold, minus the operating expenses, we get down to this magical number called EBITDA, all right? Earnings before interest, taxes, depreciation, amortization, right? And it's the first like real metric of a firm's cash flow, okay? Because it's still cash at this point. We haven't introduced any non-cash funny money like depreciation, okay? So in the case of US Corporation, now we have some depreciation, right? So we have $65 million of depreciation, which is a deduction, all right? So now we have earnings before interest and taxes. We just wiped out the D&A part, so now we're down to EBIT of 694, right? It tells us that we paid 70 million in interest, okay? So now we're down to EBT. We knocked out the interest, so EBT is 624. Taxes at 21%, easy peasy. EBT times 21% is the taxes that we're going to pay. And then finally, bottom line, we have made $493 million of net income for the business, right? Great. Now what do we do with it? Well, looking at the income statement from the handout, clearly management has decided to pay $123 million out in dividends, right? So dividends paid 123 million, okay? Which means that of the $493 million of net income, we paid 123 million out to shareholders. It's gone. It left us with $370 million that flows to retained earnings on the balance sheet, which let's talk about now. Again, if you set up your balance sheet just like this, there's nothing more that I'm going to ask you to calculate than what you see right here. Okay? Assets on the left side, liabilities and equity on the right side, listed in order of liquidity in the assets: cash, AR, inventory, net fixed assets, liabilities, accounts payable, notes payable, current liabilities. And the one thing, remember we were talking about the balance sheet for the US corporation, and we were talking about long-term debt. I said there's one thing else underneath here that it's not listed here that I think you should add. You should definitely add a total liabilities section, because when we get into ratio analysis and we start talking about total debt to total equity ratios, having that number right there is going to make your life a lot simpler. Okay, so we've got current liabilities, we've got long-term debt, we've got total liabilities, we've got the value of our common stock, we've got our retained earnings, and if we look closely, we can see that left and right side balance, we're good to go. Okay, now here's where you need to understand the flow. What's the difference between the 2017 and the 2018 retained earnings number? Somebody do that math. What's the difference between that 1690 and 1320?
$360.
How much?
370.
370.
370. Oh,
Yeah.
wait, where do we see that 370 number?
Oh, on the income statement.
Aha, there it is right there. See?
Yeah.
So the addition to retained earnings from the income statement flowed directly to the balance sheet. Okay? Right? So that relationship right there is crucial for you to understand. Okay? Once we pay dividends out, whatever is left from net income flows to retained earnings. Can anyone give me an explanation of what retained earnings is? If you're an accountant, please speak up.
Funds to funnel back into the business, whether it's reinvesting into the business or producing more inventory or whatever the strategy of the business is.
That is 100% correct. From the very beginning of time, okay? From the very beginning of time that this company existed, whatever money that they made that they did not pay out to shareholders flowed back into their business. So this number here, this $1,690,000,000, all right, that is an accumulation of all of their retained earnings since the beginning of existence. Okay, so that's the reason why the difference between 2017 and 2018 is 370 and entirely attributed to the management decision to pay $123 million in dividends out of their $493 million of net income, leaving $370 million to plow back into the business. Okay? Crystal? Clear? Crystal clear? Any questions? Don't worry about this stuff right now. We're about to get to this. But any questions about the build out of the income? If you build your income statement and your balance sheet just like this and you build a template, okay, you will not have to add anything to it for the remainder of the semester, period. I promise you. Okay. You might have to calculate depreciation. You might have to calculate the interest that you owe, but you won't have to recreate the structure of the income statement and balance sheet for the rest of the semester. Any questions? Okay. All right, back to PowerPoint. All right, so let's talk about cash flow. Again, when we talk about cash flow, as a financial manager, that's what you care about. How much real cash am I generating from my assets? Okay, not the accounting cash, but how much real cash are my assets generating? Okay, and it's probably single-handedly the most important piece of information that you as a financial manager or you as you understand financial management derives from the financial statements. Because you're pulling information from both the income statement and the balance sheet in order to compute what the real cash flow is. If you're an accountant or you look at the statement of cash flows from the SEC website that we'll look at probably next week, it's not the same thing. And you'll see why once we get into the discussion around what the statement of cash flows looks like, right? But they're not the same thing. What we're talking about here is how much cash are our assets producing? And that is what we care about, okay? How much cash is generated from the assets that we purchased, okay? And how it's paid to finance for those assets. How did we go about financing those assets, whether it was from our creditors or from shareholders, okay? Where did the money come from to purchase the assets that are generating the cash? right? That's what we care about. So when we think of it through that lens, we're really talking about something called the cash flow from assets, all right? And we can look at this two different ways, all right? Clearly, we have to have assets, right, in order to generate revenue, okay? Speaking of that, anyone want to tell me what the most challenging asset on the balance sheet is to value? Clearly, we can value cash. Clearly, we can value accounts receivable. Clearly, we can value, you know, the price of a desk in an office. But what's the most challenging asset of a firm to value?
Goodwill.
Goodwill.
Oh, there's some accountants out there.
Goodwill, yeah. People.
Ah,
IT.
goodwill. Exactly. Good. So thank you accountants or finance people. Goodwill, yeah, the intangible assets of the firm, like the human capital of the firm, right? Your brain is one of the hardest things to value for a company, right? Or the brand value, right? How do you go about valuing, say, like the Apple brand, okay? Or Anheuser-Busch, for goodness sakes, who, you know, has bought so many different brands over the course of its lifetime. You know, how do you go about valuing those intangible assets? All right. So when we get into the data detective simulation in a couple of weeks, goodwill will present itself. And so just know that goodwill is kind of like the intangible value of the firm, where, you know, it's challenging to value, and can, in many cases, as the accountants can attest to, can sometimes be grossly overvalued from a valuation perspective. All right, so cash flow from assets can, you know, we have to buy this stuff. We have to purchase our assets, right? And we got to go about doing it in one way, shape, or form. And we do it through either accessing the debt markets or issuing stock into the market. So cash flow from assets simply can be defined as the cash flow to our creditors added to the cash flow from our stockholders, okay, to our stockholders. Okay. Conversely, if we look at it from an operations standpoint, we can see it as what our operating cash flow is, minus how much money we spent for new fixed assets in any given year, right? Minus what it cost to run our business differentially year over year. So we take our operating cash flow and we back out our net capital spending, and we back out our changes in our net working capital, we get to our cash flow from our assets. So we call this the cash flow identity, all right? So the cash flow to shareholders, creditors, plus the cash flow to stockholders is equal to operating cash flow minus net cap spend minus change in net working capital. Okay, and we're going to go through an example of how this works here in just a second. Okay, so this is straight out of the book, and I'll tell you right now, like, I'm not going to, you know, require you to memorize all of this stuff, because as you know, in the real world, when you're given a project or an assignment, you've got access to all the tools that you could possibly want to solve the problem. So you can use your text, you can use this table, you can use the notes, you can use the lecture slides, you can use the presentations, the recorded lectures, you can use the internet, you can use your calculator, you can use Excel. Doesn't matter to me, okay? What I want is for you to learn the material. I want you to understand what all this stuff means. I can go hire anybody off the street, give them a formula, and they can plug it into a calculator and give me an answer. But then when I ask them to tell me what it means, they can't. That's what I expect out of you in this class. Tell me what it means. You can do the math, but what does it mean to the firm? Okay, so you'll have access to this table. So let's go take a look at US Corporation, all right, and let's run through calculating the cash flow from assets as it relates to this particular company. Okay, so here we are back in Excel. Okay, So when we're talking about operating cash flow, right, as the table tells you, you'll pick up on this pretty quickly. It's EBIT, so equals EBIT, okay? Adding back depreciation, okay? Minus the taxes that we paid, okay? We're talking about cash here. So why did we have to add back depreciation? Because depreciation is a non-cash item. So we need to get back to like pure cash. So the text walks you through step by step. EBIT, add back depreciation minus taxes. If you set your file up the way that I've suggested, you don't have to do the whole EBIT add back depreciation, okay? You can go straight to EBITDA because that's the same number. That's what we were talking about. It's the first pure cash number on the income statement. So EBITDA minus taxes, okay, is operating cash flow, okay? Net capital spending, right? How much money did we spend on our fixed assets, right? Well, pretty straightforward. Equals, what did we end the year of our net fixed asset at? What did we start it at? So the difference between the ending and the beginning, okay? But we have to do one other thing because we're talking about book value on fixed assets. Remember that. Fixed assets on the balance sheet is book value. We're talking about real cash. So what do we have to do to this formula to get it to real cash? Bueller? Bueller? If net fixed assets incorporates the non-cash item of depreciation, and we're taking the difference between two non-cash book value items, what do we have to do to that difference to get it to a cash basis? Add back what?
Depreciation.
Add back depreciation, thank you very much. So net capital spending is the difference between the difference year over year in net fixed assets with the add back of depreciation. Okay? And then we have to look at the change in net working capital. And I've taught this class for long enough that I can tell you, if you're going to make a mistake, this is where you're going to make the mistake. Okay? And you just have to be methodical about it. So remember, net working capital is current assets minus current liabilities. And when we're doing change in net working capital, we have to do net working capital of 2018 minus net working capital of 2017. Okay? Which means we have to do equals current assets of 2018 minus current liabilities of 2018 minus current assets of 2017 minus current liabilities of 2017. So now we've got net working capital of 2018 minus net working capital of 2017. Okay, and when we do that, our cash flow from our assets using the operations method is OCF minus net cap spend minus change in net working capital. This means that our assets last year, over 2018, delivered $107 million worth of value to our business. Right? It was positive. And that's what we like to see. We want our assets to be delivering value to the firm. Okay. Okay. So that's the operational way of doing it, where we're combining kind of the EBITDA, depreciation. How much did we spend? Sorry, I got a fly in my office. Depreciation, adding the non-cash piece back into it. So we delivered $107 million of cash to the firm from our assets. Now let's go to the identity side and let's talk about the cash flow to creditors plus the cash flow to shareholders / owners. Okay, so when we think about creditors, all right, and we think about the income statement and we think about the balance sheet, all right, what items on the income statement do you think relate specifically to the creditors? There's only one in this case. The people that we borrowed money from. Interest paid, right? Okay. So we have equals, we have interest paid, right? Okay. That's how much we paid out to the people we owe money to. And then we have to deduct any new borrowing that we did, because remember that net new borrowing, if that number is positive, that's actually a source of cash for the business. Okay, so it deducts from the money we actually paid to the creditors. So our net new borrowing is the difference between the 2018 long-term debt and the 2017 long-term debt. So minus 2018 long-term debt minus the 2017 long-term debt, okay? Which should make sense. We're paying money out. It's cash that's going out the door, right, to creditors in the form of interest, and we're taking on more money, which is bringing cash in the door. Okay. Now we got to look at the cash flow to the owners, okay, which relates to dividends and new equity raised. So we look at the dividends that we paid of 123, okay, minus any new equity that we raised, which brought cash into the door, which is nothing more than the difference year over year in our common stock. So common stock of 640 minus common stock of 600, okay, 83 million. So now we see the identity holds 107, 107, right? So we've just balanced it out. Okay. So when you get into some of the homework assignments that relate to chapter 2, you're going to need to remember the cash flow identity, because there will be variables that you have to solve for that you're not given that relate to creditors. But if you know what the identity is, then you'll be able to solve for that variable once you get in there. Okay. Are there any questions about what we just went through here? If you do this, like I said, if you start setting up your spreadsheet and you have an income statement and you have a balance sheet, and then you simply start adding to all of these different calculations that we're going to start going through, especially next week when we get into ratio analysis, financial statement analysis, your life is going to be immensely easier. Okay. All right.
Hey, Professor, quick question on the slides. I mean, the Excel sheet.
Yeah.
Yeah, the change in the net working capital. Can you show the formula for that again? The years that shows in?
No worries. So net working capital, remember, so net working capital in any given year is current assets minus current liabilities. Okay. So the change in net working capital is the net working capital for 2018 minus the net working capital for 2017.
Mm-hmm.
Okay. So for 2018, the net working capital is the current assets of 2018 minus the current assets of 2018, current liabilities of 2018.
Mm-hmm.
Okay. So that minus the same for 2017. So current assets minus current liabilities.
Okay, I gotcha.
Okay. So net working capital is current assets minus current liabilities. So therefore, the change in net working capital is net working capital for 2018 minus the net working capital for 2017.
Okay, I got it now.
Okay. So again, if, like I said earlier, if you're going to make a mistake, it's going to be on that one, because you're taking the change of the change, the delta of the delta. Okay.
Got it. Thank you.
Yep, you're welcome. All right. Okay. So as far as the example, we just went through it. We calculated 107. Okay. And we calculated 107 million doing the creditors and the stockholders. So I'm going to end there, and I'm going to put this slide deck is out there on Moodle. What I would suggest, just as practice, is go through this example right here. I mean, the answers are shown. They're all on the slides, okay? But use the Excel file. Okay, set up your Excel file, all right? Go through, plug in the data that's listing here, calculate the CFFA using both methods to prove to yourself that the cash flow identity works, 506 and 506, okay? And it shows you the net working capital changes, okay? So you can get comfortable with that, all right? But from here on out, everything builds, all right? So between now and next week, all right, it's very imperative that you start to get some experience using the income statement and using the balance sheet to calculate the CFFA, both methods, building the balance sheet, determining what the assets are. So let me ask you a question. I'm going to get back here to, I'm going to go back to the balance sheet here on Excel. Okay. So let's just say, for example, that I gave you this question with this US Corp, right? But I didn't give you any information around what the common stock value was for 2018. Okay. Gave you everything else. You plugged in all the numbers. You calculated retained earnings. You added the 370 to retained earnings over the 1320 to get the 1690. But I didn't give you any information related to what the value was of the common stock. So you did all this math and you looked at it and you said, well, there's not a balance. Why is this not balancing, right? So what do? Anybody got an idea? If you're in finance or accounting, you better know what to do. So if it's out of balance, and you know you've only got one other variable that can be used to force the balance, what do? Plug it. Make it work. Okay? Common stock becomes the plug variable. All right? You know you must balance. You have to balance, right? And you know the only change to retained earnings was what flowed in from the income statement. So common stock has to be whatever it's got to be to force the balance. Okay? So it has to be 640. Right? So when you get into the mini case that's due by next Monday, okay, and you're going through all the different variables that they're giving you in the table to populate the income statement and the balance sheet, okay, you're gonna have to plug somewhere, okay? You're gonna have to choose a variable, okay, to force the balance to work, okay? So work through the income statement, work through the balance sheet, getting it set up, flow retained earnings to retained earnings, and then plug common stock, okay? Questions? All right. So again, I encourage you to get some experience, go through this example in the slides. All right, build your income statement, build your balance sheet, calculate the CFFA using both methods. You've got the answers to check your work, okay? And then finally do this final comprehensive problem if you want some more work, all right? So what is due on a week from today. On Moodle, we've got the mini case, okay? The Sunset Boards mini case. Right? You've got a little brief description of a surfboard company. You're given an income statement and balance sheet information for 2 years, okay? And you're asked 6 different questions. Build an income statement for 2017 and 2018. Build a balance sheet for 2017 and 2018. Again, both sides must balance, okay? Force equity to be what it has to be. It's the plug variable. Calculate the operating cash flow from each year. Calculate the CFFA for 2018. Cash flow from creditors and cash flow to stockholders, okay? Your deliverable is to submit your Excel file with all of that work, okay, by next Monday. Okay? And trust me when I tell you, the more practice you get building the income statement and balance sheet, the easier your life is going to be over the next 5 weeks. I promise you. Because when we start to get into discount, if you need help, I'm here. All right. If you need help, call me, text me, email me, whatever. I am here to help you. Because the sooner you get, can I hover over the CFFA formula again, please? Which one? The one for the operations or the one for the creditors and owners?
The creditors and owners, please.
Okay, so it's the creditors plus the owners. And we talk about what the creditors are. The creditors are, and if you think about it, it makes sense. It's the amount of money that we pay to them in the form of interest, okay, minus the additional debt that we may or may not have taken on. So interest minus the year-over-year change in long-term debt. Okay, that's to the creditors. To the owners, very similarly, it's the dividends that we paid out to them minus the year-over-year change in the value of our common stock. And then it's the sum of both of those together that determines our cash flow from assets.
Okay, thank you.
You're welcome. Okay. All right. So if you would like to get your Excel file set up and you want me to take a look at it, just to review it, I'm happy to do that too. But when we start to get into probably 2-3 weeks from now, when we're doing 10-year pro formas and we're projecting revenues out for 10 years and discounting cash flows back to today, all right, it's really important that the math works. That way you can just copy and paste for 10 years and everything flows, okay? So if you're not comfortable with Excel, reach out and I'm happy to work with you on it. All right, any questions?
Could you hover over just the, excuse me, the OCF and the net cap spend formula again? I just need that.
So when we talk about operating cash flow, we're talking about, you know, what real cash flow do we have as it relates to the operations of our business, okay? And that number is EBITDA, because we've got our revenue and then all of our supporting expenses that go along with that. That's what EBITDA essentially means, all right? So we've got our EBITDA minus the taxes that we have to pay, because that's a cash item, right? So operating cash flow is EBITDA minus taxes, okay? Or as the text likes to do it, you could do it alternatively by taking EBIT, adding back the non-cash depreciation, which is essentially EBITDA, right? Minus taxes. Okay. Net capital spend, how much money did we spend, okay, adding to our fixed assets? So we have a year-over-year change in our fixed assets. So 1709 minus 1644, we added to our fixed assets. We used cash to add to our fixed assets. But remember, net fixed assets, these are book values, which contains that non-cash depreciation item. So if we want to know what real cash net capital spend is, we have to add back the depreciation for the year. Okay, so the change in net fixed assets, adding back depreciation. Okay, and then again, the change in net working capital is just the difference in net working capital between 2018 and 2017. And net working capital is current assets minus current liabilities. And then it's just OCF minus net cap spend minus the change in net working capital gives us the cash flow from assets. So what is this telling us, right? It tells us that from an operations standpoint, we brought in $628 million to the firm, all right? We went ahead and we spent $130 million of money to add to our net fixed assets, right? And then based upon the operations of our business, it actually cost us an additional $391 million of net working capital year over year to run our business in 2018 versus 2017. So the actual final cash flow from our assets for 2018 was operating cash flow minus net capital spending minus the incremental daily cost of activity gives us the $107 million of cash flow from assets. That's what it means. Any questions on that?
All set. Thank you.
Okay, yeah, you're welcome. So listen, thank you guys for tonight. Participation was awesome. I think it worked pretty well. I kind of just wanted to test the whole full virtual thing. I'd like some feedback as to whether or not you would like to go full virtual, whether or not you'd still like to have in-class sessions. I talked with Trish up in the in the graduate department, and the poll that went out, there's a number of folks who are actually a little bit closer to Timonium. So if we do have a group of folks that do still want to get together in person, which I'm always in favor of, I am going to chat with her about having the session moved to Timonium for those that would like to participate in person. And for those that are going to continue to participate full virtual, please let me know how tonight went. And if you'd like to see more of the, the breakout rooms and more of the case study conversation, we're going to get more into that with Heritage Doll and with the Apple, but I would please start reading those cases. The more you start to understand now, the more notes you take, the more things you start putting into Excel, the easier things are going to be. I will tell you that don't waste your time putting any of the financial statements from either case into Excel. I will be sending you an Excel file with all those numbers already in it. Okay, so you don't have to recreate the financial statements that are in those two case studies. But please go ahead and start reading those. And then, so for Monday, the only deliverable that you have is complete the Sunset Boards mini case by dropping your Excel file with your answers into that by class time next Monday. And I will have an answer by Wednesday of this week, whether or not we will be in person in Timonium or virtual next Monday. Any questions from anybody? I'm surprised nobody's asked me if I'm going to put this Excel file out there on Moodle for you guys.
That would be nice. I took a screen capture of it.
We'll see. I'm gonna let you guys do the Sunset Boards mini case and see how it turns out. If it's a complete disaster, I'll go ahead and put it out there in Excel on Moodle. But if you do need help, seriously, I'm here to help, offer any guidance or assistance. Like I said, reach out, email, call, text, whatever's most convenient. With that said, if there's no more questions, I'm going to go ahead and stop the recording and hop off for tonight.
Thanks. Good night.